I'm your host and moderator, Ryan Ruff. It's great to be back with everyone on the show today. And Homer himself is actually busy with a client at the moment. So you're stuck with me today on the show. We're going to be diving into a nice conversation. We've got Joseph Sykora joining us from over at Aptus Capital Advisors. Joseph, an equity analyst over there. And we're going to be talking a lot about kind of the earnings season, a lot of what we've seen so far, how the markets have been performing, what we can maybe expect as we move deeper into 2023 so that you and yours can have an idea as to what we're expecting. So before we get into kind of the nitty gritty of the conversation, let's go ahead and say hi to our guest of the hour. Joseph, good to see you today. How you doing?
Yeah, doing great. It's a pleasure to be back on again.
Absolutely. No, good to have you back. I know you've been busy of late. I'm sure you're being hit with a lot of questions from clients. Look, Joseph, we're in the thick of kind of the earnings season at the moment. Why don't you start us off today by talking about just kind of what you're seeing so far on your end and the conversations you've been having with Homer and his team?
Sure. Yeah. So where we are right now, we're roughly halfway through earnings season. If you look at S&P 500 issuers, and so far it's been pretty encouraging. So roughly 80% of those companies that have reported have beat earnings. That compares to a 10-year average of 73%. So you can see we're running a little bit above historical expectations. And some people are blaming now on the fact that earnings were revised lower going into this earnings season. But really, it's when you look through the earnings, it's kind of hard to chalk it up to anything other than pretty good performance. Now, that's the good side. The flip side of that is that typically when a company beats earnings, historically, you would expect that company to outperform the S&P 500 the next day by 1.5%. And we're seeing that performance on the day after earnings beat is being met with a market type of return. So not outperforming the S&P at all, whereas those missing have been severely underperforming the market. So what it's telling us is that perhaps some of this recent market run up we've seen over the last several months, where the S&P has grinded higher, mainly on the back of earnings multiples going higher, it's telling us that maybe a lot of that optimism has been priced in. So the market's not rewarding beats like they have historically.
That's good to know. And as we're kind of going our round robin about what we're seeing lately here in the markets, Joseph, let's take a look over at a recent meeting that the Feds had. And it was just this past week as we're sitting down to record today's episode on August 1st. They met last week and to end up raising the interest rates by 25 basis points. Let's talk about the implications of this, Joseph. What does this likely do, and what should we expect kind of for the duration of the remainder of the year?
Sure. Yeah. So they raised rates 25 basis points. This was fully priced into the market. Market expectations had been tuned to see this coming. And at the voting level, it was a unanimous vote. However, if you really survey market participants, I think they're all over the board on this. A lot of people see inflation perhaps being a little stickier than hoped for and want the Fed to continue to hike. Other people kind of take using the Wayne Gretzky metaphor, the skate to where the puck's at. They take the approach that inflation is coming down, therefore we don't need to hike again because we're trending in the direction of 2% inflation. Therefore, why hike again when the trend's in our favor and you risk kind of driving the economy into a recession? But nonetheless, they chose to hike. They leave the door open to hiking again at least one more time this year and continue to kind of say the narrative that they're not going to cut rates anytime in the near future, certainly not this year. If you look at expectations for future hikes, the market is saying maybe another hike this year, probably not, but maybe, call it a 50-50. But then going into 2024, they're expecting actually 5 rate cuts at this point. So 125 basis points of rate cuts next year, which really doesn't align with the Fed narrative or a lot of the market action kind of that you've seen. Just because if you would expect cuts to that degree, you'd probably expect something going wrong in the economy to some degree. And that's just not being really priced into equities at the current moment.
Sure, definitely something for us to keep our eye on. Joseph, kind of switching gears now, turning towards inflation as a whole. July 12th inflation, obviously earlier this past month showed the month of June just having 3% inflation year over year. Obviously, that's an encouraging number compared to what maybe we've seen in the past. Can we say inflation is largely behind us, or could we maybe expect a resurgence of it as we finish out the year?
Yeah, again, very polarizing topic there. So the trend of inflation has been very encouraging. It's come down from over 9% to now the reading we saw in June was just 3% year over year. So that trend's been very encouraging. Two recent points of concern, though, that could say that inflation maybe is not totally behind us. One is that, okay, if you have had a job in the last 3 years, you're probably making quite a bit more than you were 3 years ago. However, wage inflation has largely trailed general consumer inflation this whole journey until the last month, where wage inflation actually came in higher than the CPI reading, than the general inflation reading. So what that says is that wage inflation to some degree is sticky, but it also says if consumers are earning a real wage increase, then they have excess capital to continue to spend. And that's what's been driving inflation to some degree, along with supply constraints for the last 3 years. So that could be something that keeps inflation higher, especially when we're in a very tight job market. And then secondly is commodities. Commodities, especially oil, played a huge part of the inflation story in 2022. If you look at year over year inflation drops from May to May 2022, 2023, they came down huge, but a lot of that was on the back of commodities. During that time period, the Bloomberg Commodity Index was down 28%. But if you look from June 1st of this year until now, or August 1st today, so a 2 month period, the commodity index is up over 8.5%. The gasoline futures are up 30% during that time period. And we know gasoline obviously has a huge impact on consumers' ability to spend excess discretionary income into other parts of the market. If you're paying more at the pump, something you have to do, then it means you're curtailing spending somewhere else. And actually, there's been studies done that show that a 1 cent increase per gallon in the price of gasoline curtails annual consumer spending by $1.5 billion. So we're not talking about small moves here, and we're talking about noticeable trends that are starting to develop in the commodity complex. So if that starts to reemerge, then you got to think that inflation isn't entirely behind us at this point.
Yeah, no, really interesting points there, Joseph. And so Joseph, looking at all these different elements at play here, with the way the earnings season's been looking, obviously with your comment there about maybe we're not totally behind inflation. Uh, could you kind of review with us, give us kind of an overview on the situation in terms of the general bear versus bull market case? Bring our audience back up to speed on that. I know we chatted about it in a prior episode, but let's bring that back into the fold just to hit on it today.
Sure. Yeah, I'll touch on a couple points on both. The main bull case with the market is just the consumer. Employment continues to be low. XX savings continue to be high. Consumers are spending, they're getting out, they're doing, and that's driving GDP. That's driving company earnings. It's really been the force that's kind of buoyed this market higher, and that sentiment just really has continued to grow over the course of this year as coming into this year, so many market commentators expected the consumer to crack and the market to break, and that just hasn't happened. There hasn't really been signs showing yet that that's happening in a material way. On the flip side of that, you can point to a number of different kind of things that show that there is cause to be concerned. But I guess the one I'll just, for the sake of brevity, that I'll point on is not so much a particular data point that says things are getting worse, but it's just the fact that markets are starting to become much more complacent than they were at the beginning of the year. You got a situation where earnings per share for companies on a year-over-year basis is actually down. A lot of that's driven by the earnings revisions in energy and how that's come down. But nonetheless, they're down on a year-over-year basis, and yet the market is up quite a bit, and the Federal Reserve has continued to raise quite a bit. You've had a situation where manufacturing PMI numbers are down, again, in quite a severe way. But if you look at credit spreads on bonds that show the give an indication of how nervous people are about the credit quality of different issuers, those credit spreads are actually quite a bit lower than they were. They're as low as they've been going back to kind of the beginning of 2022. So you have this situation in the market where there's, of course, a not 0% chance that we do still enter a recession, or we do have a period of below trend growth, or things that could call an issue for markets, and yet they're just not being priced in the moment. If you look at valuations, if you look at the volatility index, if you look at credit spreads, kind of really across major metrics that we look at, they're just showing a lot of complacency. So, if anything, it was the opposite of that drove markets higher at the beginning of the year. Markets were very vigilant, they were concerned. But now we've kind of see ourselves in a bit of a flip side situation where if we do have any negative surprises or anything that scares to the downside, then you're not positioned in such a way to really defend against that.
No, no, Joseph, this is all really, really beneficial information for the folks out there. Joseph, as we bring our conversation to a head today, there's been a good market update in terms of where we stand here. We're sitting down again to record this on August 1st. Joseph, if you had to bottom line it for folks out there, any big key takeaway from today's discussion, what would it be, and why would you want them to make sure that they take this to heart?
Yeah, sure. I think one thing we do differently, in managing wealth is that we use hedges within portfolios, different option-based strategies in order to basically provide insurance on portfolios. So that strategy, I think, makes more sense now than it has really any time in the recent past, simply because the last point I made, that markets are just being completely complacent about the risks that are out in the market. And when they do that, the price to insure anything goes down. So we are able to enact hedges in portfolios, option-based strategies in order to help protect against drawdown while staying invested and enjoying the upside that we've seen year to date. So I think that's one thing that we do differently and better than a lot of groups. I think that serves as an advantage to us, and I think it's particularly timely given, again, kind of the cheapness of enacting a strategy like that, given the complacency that's in the market right now.
This is good stuff. Joseph Sykora, equity analyst over at Aptus Capital Advisors. Really appreciate you carving some time out of your day to be with us. Thanks again, and look forward to having you back on the show for maybe a recap, if you will, once we get to the end of 2023 here.
Yeah, that'd be great. I enjoy doing it. Thank you.
Of course. And hey, look, folks, we want to thank you for stopping by and spending some time with us today on the podcast. We know it was a quick one, but a lot of good information from Joseph and his team over at Aptus. Look, if you took anything away from today's conversation that was beneficial to you, you learned a thing or two, make sure you hit that subscribe button then on whichever platform you checked us out on today. That way you never miss out on a future conversation where myself and Homer will sit down with someone and go through, a really unique wealth management topic so that you and yours can come out better for it on the other side. But for Joseph, I'm Ryan. We're going to go ahead and say so long today, but we appreciate you stopping by and being with us on Advance Your Wealth.